Hello students, welcome to all of you Shiksha 360, and today we will cover the most important topics of your examination. Basically we can say that basically these topics they will frequently ask clear every year. They will ask questions from these topics, and these topics are not typical, but you have to understand these topics clear. But important thing for that basically you have to understand the concepts clear. So let's start. And our today's topic is basically chapter number 24, that is capital adequacy clear. Capital adequacy is basically in that chapter we will discuss Basel 2 norm overview clear. Basically in this session we will discuss the overview of Basel 2 norms clear. Basically what are the main pillars of the Basel 2 clear. Basically all these things they will ask in your examination clear. All these things they will ask in your examination, and I request to all of you, please follow point by point clear. Please follow point by point. And if you basically we will take one more session on that, 2 sessions. In the second session we will discuss numericals clear. We will discuss numericals mainly on this. And one thing I will tell you, if you follow step by step clear, if we go point by point, you will definitely able to score 4 to 5 marks basically from this topic clear. 4 to 5 marks basically we will expect from this topic clear. So let's start. Basically what is Basel norms? First of all, from where the word Basel? Basel is a city clear in Switzerland clear. From that we will take the word Basel clear. So from where it gets started clear, basically we will discuss a scenario clear. We will discuss now complete scenario on that, where it starts clear, basically where this process is going to be start clear. So basically let's start our discussion. So central bank, like in India we have RB, similarly central bank governors of the group of 10 countries clear. Initially there are basically group of 10 countries and the central bank governors clear, and the governors of basically those 10 countries, central banks clear. Initially we have 10 countries, and 10 countries we have 10 central banks clear. So basically governors of central banks of 10 countries clear basically form the banking supervisory authorities in 1975 clear. Basically they will form a committee clear in 1975. You have to remember that basically complete process clear. In 1975 they will form a committee of banking supervisory authorities clear in 1975 clear. Basically this committee basically usually meets clear. Basically this committee usually meets at the Bank of International Settlement clear, BIS. This committee basically usually meets at the Bank of International Settlement in Basel, Switzerland clear. Basically this committee where they meet clear, basically every year they will meet in Basel clear, in the city Basel. Basically this city Basel, it is located in the Switzerland clear. Basically this city is located in the Switzerland clear. So this committee basically usually meets at the Bank of International Settlement. You have to remember BIS. Sometimes they will ask these types of full forms also clear. Basel, Switzerland clear. Hence it is comes out to be known as the Basel committee clear. Basically on this name clear, on the place of the name, this committee is also known as to be Basel committee clear. Basically on the name of the place clear. Next one, initially this committee is formed in 1975. Basically after 13 years, the Basel committee provided the framework for capital adequacy in 1988, which is known as the Basel I Accord clear. Basically in 1988, when was first time Basel Accord comes, basically Basel I comes in 1988. That is basically known as Basel I Accord clear. That is basically known as the Basel I Accord clear. So now one thing basically we have to remember that basically what is capital adequacy, as they are saying that basically provided the framework for capital adequacy. Capital adequacy basically means that, like if any bank has lending, or basically if any bank has deposited 10 crore in that clear, basically, and when any one customer comes, he wants their money back, like we can say that 2 crore. Second customer comes with 2 crore clear. Basically what bank has already lent this money to further to their customers clear. So in the short time they will not return total money to their customers clear. So basically for these types of problems clear, so basically this leads to the reputation risk of the bank if they not provide the money to their customers on the time clear. Basically if they are not able to provide the money to their customer on time, then it will lead to the risk of the bank clear, reputation risk clear, and it also creates problem for the bank clear. Basically to solve out these problems, clear, to solve out the problem of the capital adequacy, this Basel Accord, one accord to be provided. Clear? Hope it is clear to all of you. Basically, capital adequacy. Like I think all of you know that basically, like in 2019, PMC Bank restrictions imposed by RBI because they have not sufficient funds, clear, to lend to their, basically to return to their customers, clear. So that is basically to handle these types of problems, these norms are to be implemented properly, clear. So now let's discuss one by one, clear. So in 1975, committee was formed. In 1988, basically after 13 years, Basel I Accord comes out to be clear. So 1988 Basel Accord basically led to significant increase in the capital held by banks over the following 10 years, clear. Earlier, bank what will get from their customer, they will lend out of, we can say that 90% portion to their customer, and very small amount they will held with himself, clear, or themselves, clear. So basically what happened after to the Basel Accord, clear, 1988 Basel Accord led to significant increase in the capital held by banks over the following, clear, over the following 10 years, clear. It deserves a great deal of credit for improving the stability of the global banking system, clear. Basically this also, if the bank has sufficient capital, basically this also helps us to basically the stability of the global banking system, clear, for improving the stability of the global banking system, clear. However, if these are some positive effects, anything, if it has some positive, it has also some negative effects also, clear. So what are, however, it does not have significant weakness. It does have significant weakness, clear. So the Basel I norms basically for risk weights were more of a straight jacket nature, clear. Basically it has some weaknesses which we will discuss, clear, regarding for the risk weight, clear. Risk weight, like we can say that we have three symbols of three different persons. One has 750, one has 690, one has 580, clear. So this the amount lent to this customer at less interest rate, little bit more rather than this, and this will, like if we are giving loan at 7%, so we will give to 8%, and for that we will give at 10%, clear. So which customer, basically in which customer we have more risk, clear. Basically in the customer C3, basically we have more risk, clear. In the customer C3, basically we have a more risk, clear. So on the basis of that, basically we will take more interest rate from that, clear, from that, clear. And for that also basically we have to provision for some amount, clear. So let's discuss what are these things. So basically, for example, these are basically regarding to the Basel I, and we will expect one question from these first three slides, clear. This is the second. So basically, for example, all exposures to sovereigns, basically we can say that basically all exposure or basically all lending to other countries were given a 0% risk weight, clear. So in the examination, they will ask basically all exposure to sovereigns has how many risk weightage, basically 0 risk weightage, clear, 0 risk weightage. And all bank exposures, clear, whatever the bank will do exposure, all bank exposures had a risk weight of 20%, clear. All bank exposure basically had a risk weight of 20%. And corporate advances, clear, basically corporate advances has a risk weight of 100%. What is the meaning of risk weight? Basically we can say that if you are giving a loan, we can say that ABC company, ABC Limited of 5 crore. So you have to sustain 5 crore with ourselves also, clear, with ourselves also, clear. The banking entity has to basically maintain 5 crores with ourselves also, clear. That is basically the meaning of risk weightage, clear. Like in the all exposure, if the bank are lending 5 crores, so basically they have to maintain 1 crore with himself also, clear, with themselves also, clear. 5 crore to that, but they have to maintain 20% of that also, clear. Not from that amount, but generally, clear, overview. Overall, they have to maintain, but not from that amount, clear. So basically such rigid, clear, these are basically strict implementations. So such a rigid approach, clear, such a rigid approach basically without any consideration from the strengths or weakness of individual entities was a main shortcoming of the Basel I Accord, clear, of the Basel I Accord. What is the meaning of that? Such a rigid approach without any consideration for the strength or weakness of individual entities was the main shortcoming for the Basel I Accord. Like we can say that we have taken C1, C2, C3. 3 persons have 3 symbols. One is 750, second is 690, third one is 580. So basically, as per this person has double A rating or triple A rating, we can say this is basically, we can say that B minus rating, and this is basically C rating. Clear? So basically, this person, if we lend 5 crore to, we can say that 1 crore to this, 1 crore to this, 1 crore to this. So basically, we have not that much maintained, like we can say that 20%, 20 lakh, as there no need to maintain for that also. For that, we can say that 10 lakh. We have to maintain 20 lakh for that. We have to maintain 20 lakh of that. So basically, this is basically, we can say that for every type of customer, clear? Either they has good rating or bad rating, clear? So basically, we have to maintain specific amount, clear, as per the Basel 1 norm, clear? So basically, this is the main problem for that, clear? That is, they are saying that all loans basically by a bank to or corporation have a risk weightage of 100%, clear? Like we can say that ABC Limited, DEF Limited, clear? If we are lending 5 crore to them, so basically we have to maintain 5 crore for them also, clear, as per the Basel norms, clear? So all loans by a bank basically to a corporation have a risk weightage of 100% and require the same of amount of capital. Example, a loan to a corporation with the AAA rating is treated in the same way as one to a corporation with the B credit rating, clear? So basically, this is the main thing they are saying that, clear? So basically, they treat all the corporation has to be equal, clear? All the corporation has to be equal. So basically, if as per the Basel norm, all the corporation are to be equal, so there is no meaning of the rating, clear? So basically, there is no meaning of the rating, clear? Basically, to overcome this, we have come with the another norm, that is Basel 2 norm. Basically, before that, we have discussed some revised framework of the Basel 1 also, clear? So you have to remember that basically this thing, 1975 committee was formed. After 13 years, Basel 1 accord comes, clear? So Basel come accord basically have these risk weightage, clear? These risk weightage. So I request all of you, if you have any issue, any problem, then you can ask, clear? These risk weightage for specific, clear? For sovereign is basically 0%, for all bank exposure 20%, and for corporate advances is to be 100%, clear? Next one. So the BCBS, so I request all of you, please tell the full form of BCBS. So the BCBS, clear, released the international convergence, clear? The BCBS basically released the international convergence of capital measurement, clear? International convergence of capital measurement and capital standards, basically a revised framework on June 26, 2004, clear? Basically when? On June 26, 2004, and BCBS basically stands for Basel Committee on Banking Supervision, clear? Basel Committee on Banking Supervision. Revised framework, clear? So the revised framework was updated in the November 2005 to include trading activities and the treatment of double default effects, and a comprehensive version of the framework that was issued in 2006, incorporating the constituents of capital, and in the 1996, basically amendment of capital, clear? There is, I think some word is missing, capital, 1996, clear? And to the capital accord to incorporate market risk, clear? To incorporate market risk, clear? So basically, you have to understand, basically time to time they will change the frameworks, clear? Basically time to time they are changing the frameworks, clear? 1996, basically amendment to the capital accord to incorporate market risk, clear? Basically in 1996 they include market risk under that, clear? We can say that under Basel 1 norm, clear? Here I will write it, wait a minute. Basically under this one, under in 1996 they include market risk under that. Market risk is to be included under that in Basel 1 norm in 1996, clear? You have to remember that, clear? So the revised framework, basically seeks to arrive at significantly more risk sensitivity approaches to capital requirements, clear? More risk sensitivity approaches to capital requirements. So the revised framework basically provides a range of options for determining the capital requirements, basically for credit risk and operational risk, clear? Initially they include market risk, later on, which we have to cover in the Basel 2 norms, they include credit risk and operational risk, clear? Basically in the Basel 1 we have only market risk. After that, basically under Basel II, we have credit risk and operational risk. Clear? So basically the revised framework basically provides a range of options for determining the capital requirements basically for credit risk and operational risk to allow banks and supervisors to select approaches basically that are most appropriate for their operations and financial markets. Clear? Basically for their operations and financial markets. Clear? So you have to remember all these things. Basically initially under the Basel I norm, basically we have market risk that was to be inducted in the year 1996, and after that basically in the Basel II norms they have revised framework, clear revised framework, and included the credit risk and operational risk under that also. Clear? So you have to remember this one. This is very, very important. The revised framework consists of, clear, they will directly straightforward ask in the examination this point. The revised framework basically what it consists of. Clear? The revised framework basically consists of three mutually reinforcing pillars. Clear? The revised framework basically consists of three mutually reinforcing pillars: capital requirement, minimum capital requirement. Second one is supervisory review of capital adequacy. Third one is market discipline. Clear? So you have to remember that MSM. This is pillar 1. This is pillar 2. This is pillar 3. Clear? Three mutually reinforcing pillar. Pillar 1, pillar 2, pillar 3. MSM. This is MC. This is MD. So many students are confusing. Basically, sir, which M we will take first? So first one is MC, MSM. You have to remember that MSM. Clear? We can say that Mahinder Singh Mahi. Clear? Mahinder Singh Mahi. So this is MC. This is S, supervisory review. This one is market discipline. This one is minimum capital. Clear? Minimum capital. Clear? So you have to make your shortcut also basically to remember, because we will expect 1 mark question from that also. Clear? In any set you will get 1 question from that. Clear? The revised framework consists of three mutually reinforcing pillars. First one is the minimum capital requirement. Second one is the supervisory review of capital adequacy. Third one is the market discipline. Clear? Chapter number 24 basically based on that. Chapter number 25 is basically based on that. Chapter number 26 is basically based on that. Clear? 3 chapters are basically on 3 pillars. Clear? Basically 3 chapters are basically on 3 pillars they will cover. Clear? So let's start. First pillar. One thing more. The Basel II capital requirements apply to internationally active banks. Clear? Basically these Basel II norm is not applicable at all banks. Clear? It is not applicable on banks. Basically, first of all, we will discuss here and regarding the US and other countries, and after that we will move towards India. Clear? So the Basel II capital requirements basically apply to internationally active banks in the United States. Clear? In the United States, basically there are many there are many regional banks, and the USC regulatory authorities have decided, clear, that Basel II will not apply to them. Clear? Similarly, like in US, Basel II norm is not applicable on regional rural banks. Similarly, in India also, small regional banks. Clear? In India, we have regional rural banks. In US, basically, we have small regional banks. Clear? Like in the US, basically, Basel II norms are not implemented on the small regional banks. Similarly, in India also, clear, these Basel norms, clear, basically, these Basel norms are not, clear, basically, these Basel norms are not implemented on the RRBs. Clear? We will discuss also basically where on which other banks this will not be implemented. Clear? So these banks will be regulated basically what is termed Basel 1A, which is similar to Basel 1. Clear? Basically, so what are the implementations on these? Basically, Basel 2 are not implemented basically in US, basically that is Basel 1A. That are similar to the Basel 1 norms. Clear? It is likely that some of the larger banks may manage risks in a sophisticated way. In Europe, all banks, basically in Europe, all banks, either they are to be large or small, will be regulated under the Basel II. Clear? Basically, this provision basically regarding Basel II norms is not implemented in US, not on small regional banks, but in Europe. Clear? But in Europe, it is to be implemented on all banks, either they are to be small or large. Clear? Because Basel norms are basically formulated in Europe. Clear? Because Switzerland is one of the country of the Europe. Clear? So basically, in addition to that, the European Union requires the Basel II rules to be applied to securities companies as well as banks. Clear? Basically, like in India, Basel II norms is implemented only on the banks, not on the insurance companies. Clear? Not on insurance companies. But in European Union, basically requires the Basel rules to be applied to securities companies as well as banks. Clear? Basically to securities companies as well as banks. Clear? So basically it depends upon bank to bank. Clear? Basically it depends upon country to country. Basically how they will implement. Clear? How they will implement. Like as per the Basel 2 norms, basically CRAR has to be maintained 8%. Clear? But India, basically we have to maintain CRAR basically to be 9%. Clear? CRAR basically we have to maintain 9%. Clear? So now let's move towards the Basel 2 revised framework. Clear? Basel 2 revised framework. Clear? Basically the image showing on your screen, basically every time this is basically 1 mark question. 1 mark question. Basel 2 basically, as basically this is a hut type shape. This is a hut, and this hut is basically based on 3 pillars: pillar 1, pillar 2, pillar 3. These pillars are basically MSM. This is Mahinder Singh Mahi, and this is MCMD. So this one we can say that minimum capital requirement. Second one is supervisory review process. Third one is market discipline. Clear? Third one is a market discipline. Clear? So basically these is the revised framework. Clear? So these is the revised framework, and you have to remember this one. Clear? You have to remember this revised framework. This is very, very important for the examination point of view. Basically revised framework. Clear? So let's start our discussion on that. So basically these 3 pillars under the Basel 2. We will discuss also these 3 pillars under the Basel 3. But first of all, we have to discuss basically what are these 3 pillars under the Basel 2. Pillar 1 is MSM. This is B, this is C. So first one is minimum capital requirement. Clear? So capital requirement basically for what risk? Credit risk, market risk, operational risk. As basically we have already discussed, that is market risk basically included under the Basel 1 norm in 1996. But these are basically new measurement, credit risk and operational risk basically include later on under the Basel 2. Clear? So credit risk and operational risk. Clear? So minimum capital requirement basically credit risk, market risk and operational risk. Basically these 3 risks are come under the minimum capital requirement. Clear? So market risk, it is unchanged basically as we have already under that. Credit risk and operational risk basically both are to be newly introduced. And I will not discuss now on pillar 2 and pillar 3. So basically these 2 pillars we will left. This pillar is basically for chapter number 25, and this pillar we will left for chapter number 26. Clear? So now pick up first pillar from this Basel 2 pillars, norms or revised frameworks, and let's discuss in detail on that. Clear? Basically from that we will expect risk weighted assets, numericals. Clear? Numericals or important MCQs. Clear? Very, very important MCQs they will ask from these model. Clear? Or basically from this diagram. Clear? This diagram is similarly present in your book. We will discuss on that also. Clear? Basically the revised framework basically consists of 3 mutually reinforcing pillars: the minimum capital requirement, the supervisory review of capital adequacy, and third one is the market discipline. Clear? So the revised framework basically consists of 3 mutually reinforcing pillars. First one is the minimum capital requirement. Second one is the supervisory review of capital adequacy, and third one is the market discipline. Clear? Third one is the market discipline. Clear? So what is the pillar 1? Under the pillar 1, basically we have already discussed pillar 1. Pillar 1 basically consists of credit risk, market risk and operational risk. So basically under the pillar 1, the framework offers 3 distinct options for computing capital requirement. Clear? Basically pillar 1 as basically minimum capital requirement. So you have to remember what minimum also. Clear? Basically in one time, I think in the year 2019 or 2020, basically they will ask, basically under pillar 1, we have to require minimum capital or maximum capital. Clear? They will ask one question by taking formulas. Clear? Basically formula for the risk weighted asset. So we will discuss on this question after the session. Clear? In your group. Clear? Basically, after completion of the session, when we will discuss MCQ, we'll provide you that question also. Clear? So basically, under pillar 1, the framework basically offers 3 distinct options for computing the capital requirement. Clear? Capital requirement basically for what? For credit risk, and 3 other options for clear. Basically, 3 options for the credit risk and 3 other options for computing capital requirement basically for the operational risk. So these options for credit and operational risk are basically based on increasing risk sensitivity and allow banks to select an appropriate approach. Clear? To select an approach that is most appropriate. Clear? That is most appropriate to the stage of development of bank's operation. Clear? Basically, these are three approaches for all these risks. Clear? Basically, there are three approaches basically for all these risks, and the bank has to select an approach basically that is most appropriate. Clear? Basically, that is most appropriate to the stage of development of bank's operation. Clear? So let's discuss basically what are the 3 approaches. Clear? Under this one, basically we have 3 approaches. Under this one, basically we have 3 approaches. Under this one, basically we have 3 approaches. Clear? So let's discuss one by one. Basically, what are the 3 approaches basically we have under all these 3? Clear? Basically, under all these 3, basically what are the approaches we have? Clear? So let's start one by one regarding that. So first one, clear? First one basically we have for the credit risk. Clear? So the options available. Clear? The options available for computing capital. Clear? The options available basically for computing capital for credit risk. Clear? Basically for computing. Clear? Basically how much capital, basically minimum capital we have required for the credit risk. Clear? So basically what are the 3 options basically which we will take? Clear? Or what are the 3 approaches? Clear? What are the 3 approaches basically which we will take here? First one is the standardized approach. Clear? First one is the standardized approach. Second one is the foundation internal rating based approach. Clear? First one is the standardized approach. Second one SFA. You have to remember that. Standardized approach. Second one is the foundation internal rating based approach. Third one is the basically advanced internal rating based approach. Clear? First of all, basically we have standardized approach. Clear? Second one, basically we have take a journal. Basically we can say that foundation internal rating based approach. Clear? Third one, basically we have take advanced internal rating based approach. Clear? We have standardized approach in all the 3 capital risks. Clear? Basically we have standardized and advanced. Clear? Basically one approach is different, rather basically we have same approach in all this. Clear? For first one, basically for the credit risk, basically we have standardized approach. Second one is a basically foundation internal rating based approach. Third one, basically we have advanced internal rating based approach. Clear? Basically these are the 3 approaches given by the Basel committee. Clear? But in India, basically we have take specific approach. Clear? We have take basically like for the credit risk. Clear? Basically we will take standardized approach. Clear? Basically in India we will take adopt for credit risk. Basically we will we adopted standardized approach. Clear? You have to remember that also. Clear? We will discuss later also, but you have to remember this one. Next one, basically the options available for computing market risk. Clear? Basically the option available for computing minimum capital for computing market risk. Basically first one is the standardized approach. Clear? Here standardized approach is basically divided in 2 parts. First one is on the basis of maturity ladder. Clear? Maturity ladder. Second one basically on the basis of duration based. Clear? Duration based. And second one basically we have advanced approach. Clear? Advanced approach basically internal models such as value at risk. Clear? Internal models basically such as value at risk. Clear? So basically in the examination they will ask basically which approach. Clear? Basically which approach we will take. Basically we will take standardized approach. Clear? Basically we adopt. In India, which approach is adopted? Basically standardized approach. Clear? So you have to remember that basically for the capital risk, sorry, for the credit risk and for the market risk. Clear? Basically for the credit risk and for the market risk. Clear? Basically for the CM risk. For the CM risk, basically we have to approach SD approach. Clear? Standardized approach. Clear? For the CM risk, basically for the credit risk and for the market risk, basically we have to approach the SD approach, that is standardized approach. Clear? Standardized approach. So now basically we have left with only third risk, that is operational risk. Clear? Operational risk, as we have already know that basically in operational risk, basically we have first one is the standardized approach, second one is the advanced measurement approach, and third one is the basic indicator approach. Clear? BIA. Clear? Basically, third one, basically we have available BIA, that is basic indicator approach. And in India, basically we have adopted the basic indicator approach for that. Clear? Basically for computing capital for the operational risk, basically we have take the basic indicator approach. Clear? Basically we have take the basic, or we have adopted the basic indicator approach basically for computing the minimum capital for the operational risk. Clear? So basically these are the some important points. Basically, first of all, we will discuss here three pillars. So three pillars, first pillar is minimum capital requirement. Second one is supervisory review. Third one is the market discipline. Clear? So basically in this chapter, basically we have to discuss in detail pillar number one. Pillar number one, we have three risks. So we have to minimum capital for these three risks. First one is the credit risk. Second one is the market risk. Third one is the operational risk. Clear? Basically, for all these risks, basically we have three options available, and we have already discussed these three options and which option is used, basically which option is adopted in India. Like for clear, like for we can say that for credit risk we have adopted standardized approach. For computing market risk, basically we have adopted standardized approach, and for computing operational risk, basically we have adopted the basic indicator approach in India. Clear? So basically in this session we have to discuss up to this much point, and in the next session basically we will discuss some formulas on that, and we will also discuss numericals on these things. Clear? So thanks to all of you basically for joining this live discussion. Clear? So thanks to all of you.